They said inflation was heat. They said unemployment was cold. They said the two could not live in the same room, but the doors locked behind us, and the room began to sweat. Prices rose, factories idled, paychecks shrank in everything but ink. It felt like a fever and a famine together, a paradox with a paycheck attached. If you listened closely, you could hear history whispering a simple truth. The economy is not a machine of equations. It is a civilization of promises. When promises fray, you get a phenomenon we gave a polite name, stagflation. For a generation, textbooks kept the peace with a curve drawn on a chalkboard wall. The Phillips curve offered comfort. If prices were rising, jobs must be plentiful. If jobs were scarce, prices would calm. It was a trade you could manage. But curves trace history only until history turns. After the Second World War, the victors built Bretton Woods on granite certainty. $1 convertible into gold at 35 per ounce, other currencies tethered to the dollar, commerce and capital moving along rails of trust. The design was diplomatic money. Gold in the basement, dollars on the counter, and the world buying American stability with American deficits. It worked until it didn't. The paradox began with abundance. Dollars poured overseas to rebuild allies, to garrison troops, to buy the post-war order. Europe and Japan healed, exported, accumulated claims. By the late 1960s, the arithmetic no longer whispered. It shouted. Foreign governments could, in theory, present their accumulated paper for the metal in the basement. The basement wasn't deep enough. On an August evening in 1971, the convertibility promise snapped. The gold window closed, the anchor was cut, and the ship began to drift. Prices, which had been moored to a metal certainty, were now tethered to faith, in policy and restraint, in the ability of leaders to measure out money without measuring rods. What happened next smelled like oil. The first shock came in 1973, not as a footnote in a textbook, but as a blockade with a pulse. Producers did not simply raise a price, they asserted power. Tankers hesitated. Refineries strained. The world discovered that its prosperity was distilled from ancient sunlight, and that this sunlight could be rationed. The math of production cracked. Energy, an input to every other input, became a lever. Cost-push inflation rose while output stalled, and the old map had no symbol for both storms at once. The lines at gas stations were not just lines, they were equations standing in the open air. A gallon bought anger, an hour bought less. The real fuel was not gasoline, it was expectation. Inflation crawled into contracts. Cost of living adjustments turned fear into policy. Unions bargained forward. Firms priced forward. Households shopped forward. When people expect prices to rise, they run ahead of them. When everyone runs, the road tilts upward. Even productivity could not catch its breath. Investment shied at uncertainty. Managers defended margins by printing price lists faster, not by building machines better. The psychology of money became the engine of money, and it pulled wages and prices in a dance that made no one richer and everyone tired. The economy flickered. A hiring freeze here, a pay raise there, purchasing power warped by the hour. The coins looked the same. The value didn't. Then the second wave struck. In 1979, revolution in Iran sent another tremor through energy supply. The shock was not just barrels lost, but confidence shattered. Policymakers lurched, tightening, then loosening, braking, then accelerating. Stop, go became the phrase. Monetary policy as a driver pumping the pedals in traffic no one understood. Each reversal taught the public a harsh lesson. Do not believe the signal. Believe your own survival. The bond market learned to squint at every headline. The supermarket learned to reprint tags faster than the newspaper. The homebuyer learned that mortgage rates could climb like ropes into a dark sky. A central banker finally walked into the room with a hammer, not a scalpel. Paul Volcker decided to price time differently. Interest rates rose until they were not simply high, but frightening. Borrowing slowed, factories went silent, unemployment climbed, bankruptcy clerks learned new names. The policy was not delicate, it was decisive. The objective was not comfort, it was credibility. The public had to believe that money would be hard again, that the yardstick would stop shrinking in the night. In 1981, the pain peaked. By 1982, inflation bowed. A regime ended, and a new one began, stamped by the understanding that the value of currency is the value of the institution willing to defend it. We call this era modern, but its bones are ancient. Consider the 16th century, when silver from the New World flooded into Spain and then across Europe. Treasure galleons seemed like wealth on sails. But money is not treasure. Money is measurement. When too much silver chased too few goods, prices crept upward for decades. Wages lagged. Debtors smiled. Creditors scowled. The Spanish crown mistook a windfall for an income and built commitments on vapor. Empire looked firm, but inside the ledger it hollowed. The phenomenon has a scholarly name, Europe's price revolution, but the feeling was familiar, a slow stagflation where a society's apparent riches obscured the weakness of its productive core. When a nation confuses metal with mastery, its coins grow heavy even as its power grows light. Rome wrote this lesson on stone. When the empire's needs exceeded its tax collection, the mint became the ministry of miracles. Silver content fell. Denarii thinned. Soldiers demanded more coins to buy the same bread in the same market stalls. Grain shipments slipped. Frontiers were expensive. Promises multiplied. Inflation in a world of legions and roads was not a number. It was a signal of political strain. The Ottoman experience later rhymed akçe debasement, arrears to janissaries, price rises in the bazaars, a grand machine grinding under the grit of fiscal shortfalls. Military power needs trust. Trust needs honest money. Honest money needs discipline. Remove any one link, and the chain tugs at the rest. The world tried paper answers. In revolutionary France, the assignat was born against land, a mortgage to fund a new order. The first issues lubricated trade, the later issues drowned it. By 1790, the press no longer printed stability, but desperation. Bread prices leapt, queues formed, merchants guarded their doors against customers who now felt like creditors, clutching notes that promised meaning and bought less of it. In the American Revolution, the continental currency proved how quickly paper pride can slide into barter. Not worth a continental was not a slogan, it was a social diagnosis. When money fails, people begin to hoard goods and relationships instead. Each of these episodes shares a quiet constant: legitimacy. Stagflation is not just a macroeconomic puzzle. It is a test of belief. It thrives when governments try to promise everything: growth, low prices, secure jobs, while the real economy bumps against limits of energy, demography, debt. In the late 20th century, the lesson ended in a central bank's fierce defense of the unit of account. In earlier centuries, the lesson ended with clipped coins, angry breadlines, or a ship whose silver made it sink. And yet, the pattern endures because the temptation endures. To smooth over structural friction with financial lubrication, to swap discipline for credit, to mistake asset prices for prosperity. In our time, the ingredients sit quietly on the table. Demographics age like wine that does not refresh the glass, more retirees, fewer workers, a balance sheet absorbing future claims. Energy transitions ask for massive investment before the returns arrive. Grids, mines, and supply chains must be built in a world that wishes them to be invisible. Globalization carried deflation in its hull for decades. Reshoring and redundancy now add costs we used to pretend did not exist. Above all, the tower of debt leans. Public and private obligations promise tomorrow's income today, then tomorrow again and again, until servicing the past shadows the future. If a shock arrives, war, pandemic, embargo, drought, the old paradox can reassemble itself, quietly at first, then with volume. Do not confuse technology for immunity. Every empire that debased its coin had engineers. Every ministry that printed too much had clever men with ledgers. The problem is not cleverness, it is the physics of promises. Money is a claim on the real, on wheat, steel, care, energy, attention. If claims expand faster than the real can be delivered, someone must be disappointed. Inflation spreads that disappointment thinly across everyone, invisibly, daily. Recession concentrates it on the few, visibly, painfully. Stagflation tries to do both. It is the worst sort of fairness, the fairness of universal loss. There is a human portrait here, worth lingering on. The worker who negotiates a raise and still falls behind at the grocer. The small manufacturer who delays a machine purchase because tomorrow's rate could erase today's margin. The retiree who discovers that thrift has no defense against a currency that no longer remembers what a year means. The policymaker who reads 3 dashboards pointing in different directions and chooses a compromise that satisfies none. The landlord whose mortgage costs surge while tenants stare at their own shrinking budgets. Everyone makes rational choices inside a world that is irrationally arranged, and so the system drifts into a place where patience looks like surrender and urgency looks like panic. There is, too, a moral geometry. Inflation rewards proximity to the spigot, the first receivers of new money, the balance sheets that can pivot, the assets that climb the ladder before wages wake. Stagnation punishes the periphery, the latecomers to credit, the towns far from capital rivers, the skills not immediately repriced by the new tide. Together, they widen the distance between map and territory. Politics notices. Narratives harden. The search for villains replaces the search for balance. History warns that when a society looks for culprits instead of causes, its solutions become expressions of anger rather than repairs of structure. And what does a civilization do when the old promises corrode? It can relearn the discipline of sequence. First build, then borrow. First produce, then distribute. First invest in the roots, then measure the branches. It can face the arithmetic of energy and materials and accept that not all ambitions fit inside the same decade. It can assign value to time, real interest rates that tell the truth, and let that truth guide capital toward the patient things: infrastructure, education, productivity. It can acknowledge that social trust is a form of national wealth as tangible as copper or grain, and that eroding it with surprises and improvisations is a hidden tax with a compound rate. But the documentary does not promise a happy ending. It promises a clear ending. In 1982, the fever broke because someone chose to make money believable again at a cost measured in closed factories and boarded windows. In the 1500s, the fever never really broke. It became the slope down which an empire slid, heavy with silver and light on solvency. In revolutionary times, the fever turned crowds into economists, counting loaves, counting days, discovering that paper courage cannot conjure flour. The common thread is that trust is both fragile and expensive. It is frayed by denial and purchased with pain. No society gets a discount. So listen to the word itself, stagflation. The first half is stillness, the second is motion, like a statue that sweats. It tells you that economies are not machines, but living ecologies where prices, expectations, resources, and institutions fuse into a weather system. Sometimes the storm that forms is one you were told could not exist. The wise response is not to argue with the storm's definition, but to respect its power, rebuild the levees, and stop pretending that a river will flow backward because your model prefers it. History does not repeat, but it rhymes with precise cruelty when we ignore its meter. The coins can look the same, the value need not. The curve can hold until the day it doesn't, and when that day arrives, the most dangerous illusion is that a paradox is a mistake in the data. It is not. It is a mirror in which a civilization sees itself and must decide whether to change the face or change the light.